And share my screen here with you. Does that everyone see the screen okay?
Yes.
Okay, well, in the about an hour we have here tonight, I hope to enlighten you a little bit about the soybean, corn, and wheat markets. I'm going to take an approach of looking at what's happening at the national level first, and then we're going to drill down to North Carolina. And I'm going to take a little different approach than what I usually do. I'm going to start with some of the real highlights because I expect I might put some of you to sleep in the first 3 to 5 minutes. So I'll try to get the good stuff out first. But let me just start with what's happening in our soybean, corn, and wheat markets. There's one thing that you should see across these three charts. These are a 10-year history. We've got soybeans at $14, corn at $5.50, and wheat at $6.50. We're essentially at new 5 and 7-year price highs, and these new highs are being established ongoing. What do I mean by ongoing? Well, if you look at how these prices are moving here in this last month, they continue to go up at a fairly significant rate. It's almost vertical, and it changes every other few days where we're establishing new highs. So far, there isn't any resistance to that, and I hope to put a little bit more background on why this is the case. But this is not unusual to see soybeans and corn move together, but we're also having wheat go up with these guys, and it typically trails. But this is something that we've really needed in agriculture over the last 3 or 4 years, and that'll become more obvious here as we get along. Another thing I want to point out, and this may not be obvious to a lot of folks, is, and some of the media aren't really talking about this, the futures markets are inverted. Okay, what does inversion mean? Well, when you compare the nearby futures contract, for example, for corn, soybeans, and wheat, when we look at the March futures contract as compared to the harvest contracts, which is December for corn, November for soybeans, and July for wheat, they're inverted. In other words, the cost of carry for grain right now is negative. Typically, we see the deferred contracts trade higher as an incentive for people to potentially store their grain. So the market's willing to pay you a positive cost of carry. But we see that the corn market is inverted by almost $1. Soybeans is inverted by $2, and wheat's about 15 cents. When you look at it as a percentage, corn's about 82% of the new crop, soybeans is about 85%, and wheat's 98%. So when futures are inverted, it reflects that the current supplies are tight and there's a scarcity of stocks. Basically, the higher nearby prices incentivize sellers to price and deliver now. So if you are setting on some old crop supplies, these futures markets are telling you now's a good time to move some of that and sell it now because the market is inverted. So that's something to keep in the back of your mind when you're thinking about um, what you should do with old crop. In other words, it's going to cost you even more money to carry to move into further months because the futures markets are going to be prices are going to be lower. The other thing that we have, which is somewhat unique, the ending stocks in all three crops have been on the decline now for at least 3 years. And let me start here with corn. So typically we have about 2 million or 2 billion bushels of ending stocks when you compare the last 5-year average. But what this shows you is over the last 3 years, we've depleted our ending stocks by about 2.2, from 2.2 billion down to 1.5 billion, and it's continuing to decline. The calculation I like to do that puts it into perspective, as we move into 2021, given the current carry out that we're bringing into the new crop, and based on how much we typically plant, we can only take a 10% hit in yield nationally and we'll be out of corn. That gives you some reason or some explanation as to why we see that such vertical movement in the corn price. When we look at soybeans, it's even more dire. We've had soybean ending stocks now depleted from 895 million bushels down to 140 million bushels in 3 years. Typically, we average about 500. So we can only afford about a 4.5% of expected yield decline and we'll be out of soybeans. Why is this so important? This gives you some idea of how elastic the prices might be if we have a crop shortfall in 2021. There is no guarantee that we won't have some sort of weather market. That's always a risk, as you know, in agriculture. And then finally, the wheat market, we see that wheat ending stocks have been declining for almost 5 years. Now, we're not at a level where we should be concerned. It's about 30% of our ending stocks, but it's still important to point out we've got all three markets where ending stocks are shrinking. That means it's even more important in 2021 to have a good crop. And if we have any weather hiccups, then you can see we'll have the futures market spike. So, what has been a predominant factor in these ending stocks for all three crops shrinking? And you have to dig a little bit in the data, but one thing that's been driving these markets and reducing our ending stocks is increased exports. Corn exports are up 21%, but the big gorilla has been China. Typically, Mexico and Japan are our biggest customers, but China have entered the corn import space and increased their imports from the US from a mere 12 million bushels to 213 million bushels. That's a 1,600% increase. Similarly, for the soybean market, the Chinese are our biggest customer, and US exports are up 14%, but the big player again is China. China have increased their imports of soybeans almost 40%. And that's about 300 million bushels. And if you remember, our ending stocks are typically 500 million bushels and we're down to 140. So that huge reduction in soybean ending stocks can almost all be attributable to China. And finally, the Chinese have also increased wheat exports up 630%, although our exports of wheat are down slightly at 3%. So a take-home message is China is playing a predominant role with their increased imports of US grain, corn, soybeans, and wheat that's helped running down our ending stocks. All right, let's just turn more to the income statement. There's something that really should pop out here. This is the 2020 forecasted US agricultural economy, basically snapshot. And what it shows is we're at a new 7-year high. But what you have to look at carefully here is this is almost all due to government payments. Okay. So net cash income's up about 22%. It's almost at the level it was in 2013 when we had a record. And cash receipts are down just a little bit from last year. But the reason why this net farm cash income is up is direct government spending increased over 100% between 2020 and 2019. In 2019, it almost doubled as well. So we have government spending up almost 300% compared to 2013. So we have relied on direct government payments to pay approximately or to account for about 36% of net farm income. That's a real concern, and I'll tell you why here in a minute. But when you look at this, as I mentioned, it's about 36%. So you can see from 2018, 2019, 2020, we really began to crank up the direct government payments. And this is at a level that it's been, I think you have to go back to 2001. But typically we only spent about $10 billion on government payments. And then starting in 2019, 2020, it really went up. And I think you can all guess what the government payments were from, but here's a breakdown. You can see that this dramatic run up in government payments has been driven by supplemental and ad hoc disaster assistance. It went from about $1.5 billion in 2019 to a whopping $32 billion in 2020. So what's in the supplemental ad hoc and disaster assistance? It's coronavirus food assistance programs, small business administration paycheck protection, which agriculture benefit from, and wildfire and hurricane indemnity programs, the WIP. Then you can see more modestly, we've got the PLC, the ARC, market facilitation programs, and then conservation, which stays pretty steady at around $4 billion. So the key take home from this is this supplemental and ad hoc disaster assistance programs, they're one-off payments. So we shouldn't expect to see these again in 2021. And so we're going to have the market make up a lot of these income. But the good news is the prices are starting to move in that direction. So that's the thing to be positive about. This picture, which is essentially just a graph of what I showed you, makes it really clear the nature of these 2020 payments, how the supplemental and ad hoc disaster assistance was essentially off the charts. PLC and ARC weren't much. Conservation remained sort of flat, and the market facilitation programs had a lot to do with the trade war. Let's move along to acreage and thinking about what might happen moving into 2020. 21, I'm sorry. In 2020, we had a small uptick in corn acres, a fairly drastic increase in soybean acres, and wheat and cotton acres declined. Net, we increased total acres about 5 million acres. Here's a breakdown of it across corn, soybeans, wheat, and cotton. So we increased combined acres about 5 million. Soybeans got the lion's share of that, about 7 million. Now, the big question in everyone's mind moving into 2021 is, can we get back over the 230 million acres planted with the kind of prices we have? And all expectations is we probably will. The question is, will it be more soybeans, more corn, or more of both? Okay. So one way we can get a guess of what, or a measure of what might happen moving forward, is to look at what has happened to soybean and corn acres in the past from year to year. You can see here that there's typically a pretty big chop and change because soybeans and corn compete with each other for acreage, and it's particularly important in the Midwest. So we have this rule of thumb. Around pre-planting time, which is January to sort of March, corn, soybeans, and wheat and corn and soybean futures get into a bidding war. So a good rule of thumb is if you look at the new crop soybean futures over the corn December futures, the ratio of that, typically it's about 2.4. And if that ratio is below 2.4, it's a signal to plant more corn. If it's above 2.4, it's a signal to plant more soybeans. And if it's around about 2.4, you'd expect acreage to stay the same. So let me see if I can sort of prove this to you. So here we have a fairly long history of this ratio of November soybeans with December corn. And you can see the average is 2.4, which is sort of that break-even level. And you can see how much it fluctuates, as high as 3.1 down to as low as 1.7. And like I told you, the 2.4 is sort of the magic number, the number you want to keep in your head. And when it's above 2.4, that's a signal to plant beans. When it's below 2.4, it's a signal to plant corn. And if you look at where futures were yesterday, right now the market is signaling to plant more soybeans. And that's consistent with what we saw with those really short ending stocks. But corn wants to get its own fair share, and that's the catalyst right now for those markets rallying. Now, to prove this point a little bit more, and this is not a very clear graph, but it's difficult to try to put these both on the same page, here's how well this rule of thumb works. These green lines indicate the times when it was above 2.4, and you can see every time there's soybean acreage spiked. Okay, so pretty consistently, we had 5 years there where it spiked. When you look here now, this is the times when corn spiked. And you can see it was well below 2.4. Okay. And then finally, when you look at when it was pretty flat, you'll see right here that it's right around the average, not always. So this rule of thumb isn't perfect. That's why it's a rule of thumb, but it's a pretty good gauge. And right now, we think the market's poised towards more soybeans. Okay. So let's have a look at the balance sheet for each of the crops now. And there's a few points here that will help further dive down about why prices are where they are. First of all, like I said, the area planted in 2020 was only a modest increase. We had pretty good yields. They were up about 2.7%. Remember, corn trend yield nationally is about 2 bushels an acre. Big thing is total supply then only went up about 1.5%, but total use went up 4.4%, and the driving factor, as we always already discussed, was exports. Another important thing is ethanol held its own in 2020, and that's pretty critical given some of the dire things we saw in March with the lockdown, because ethanol production is highly tied to gasoline. Okay, so this fairly significant increase in total use over total supply has provided a really good reduction in ending stocks, down about 22%, which has boosted prices up 18% to an average predicted price of 420 in 2021. This is now a historical chart of supply and disappearance, and I want to make a couple of points here to put this into context. So first of all, we can see up here the total use is outstripping production, which has led to the reduction in ending stocks. But you can see here the record level exports. What we don't see here is domestic use at a record levels, and that's because ethanol did struggle some, and so there was some other factors down as well. But food, seed, and industrial certainly had a slight increase. Sorry, that was the ethanol. The domestic use in terms of feed was down, and that's also tied to what happened in the livestock industry when we had all the stuff that happened in March and April with the COVID and the biological impacts that had from the slaughter plants having to get that. We had the slaughter plants down about 40% for a month or two. Finally, one thing I wanted to point out about the stocks and price is there's an inverse relationship between stocks and price. And we're now in the territory where you see we don't need much more of a reduction in ending stocks to get a pretty big increase in price. So any shortfall we might have in production in 2021 is going to end up in a fairly large increase in price. In particular, we don't have to go too far below the ending stocks to get above $6 corn where we were in 2011, 2013. Okay, so this is a pretty what we call inelastic relationship. All right, let's have a look at the corn futures. The nearby, remember, that's trading at a premium over the new crop price, but we've seen a gain of about 70 cents since November, December. Okay, and that continues to trade up. And there's really no sideward movements in that March contract, and that's because the market's inverted and the market really wants your grain right now. When we go to the December contract, we're right now at about 450, and we've had a gain of about 80 cents. But you see the market's is starting to trade sideways now at about 460. One reason for this is the market's trying to build expectations about weather forecasts and what type of crop we might have in 2021. And also it's concerned about acreage in 2021. Remember, by December 2021, we'll have the soybean and corn crop. So this is potentially building in expectations here, and this is the crop that's bidding for acreage. You'll see something similar here in soybeans. But it's important to note again that in the March contract, the nearby contract, we haven't had this sideward movement. It continues to go up. but the deferred contracts are beginning to trade a little bit sideways. Finally, using the futures prices, I did some calculations to be able to make some probabilistic statements about where we think the December 2021 futures might be. What I'm able to do is use the current options premiums to make some probabilistic statements about how high can the 2021 December corn contract go. And according to the market right now, there's about a 50% chance that the December 2021 futures contract will finish up about 450. There is about an 8% chance that it'll be higher than $6.11. And there's a 8% chance that it'll be lower than 324. So you can see right now there's still a wide berth about how much prices can go down, how much prices can go up. But if you think we're going to have $6.50 corn on the futures, right now the market's saying it's not going to go that high. Okay, so that stops short of where we were in 11 and 12, I think. But hopefully this is helpful to form some expectations moving forward. All right, let's turn to soybeans, and we'll see here on the acres planted, we had a pretty big jump in soybeans, okay, and that was because of the shrinking ending stocks. We had a much more significant increase in yield than we expected. Typically, a trend yield in soybeans is a 1 to 1.5 bushels an acre. We had almost 3 bushels an acre. We started the year with a 42% reduction ending stocks, of course, turned into beginning stocks. Total supply was up 5%. And look at total use, up 15%. And I can tell you, and we'll see this in a minute, exports up 32% and crushes up 2%. We have both crush and exports at record levels. And that's what's driven ending stocks down about 73%, which has led to this 30% increase in prices, or $11.15. So the historical supply and disappearance numbers here help us a lot. We see right here that exports are at record level. We already pointed out that's the presence of China and the buying up they've increased their exports about 40%. But we also see that crush is up at record levels too. So when you take crush at export levels and crush domestically at record levels, that's what's leading to this big gap between total use and production and the significant reduction in ending stocks. This is why you've seen that soybean price almost going vertical, and will continue to do that as soybeans try to bid acreage away from corn. And this is the very positive story for corn and soybean farmers going into 2021, that supply and demand is going to dictate the prices need to go higher as we need to plant more so we can build up our ending stocks back to more the average levels we expect. Now, the stocks to use for soybeans makes my point very clear here about how inelastic this relationship can be. You can see how steep the reduction in stocks to use is here in this market, and then you've had a fairly significant increase in price. So you can imagine we don't have to go much more or much less in ending stocks to get soybeans up here at the $13 level. We're very, very close. We only have 140 million bushels in ending stocks. Similarly, for the March contract, we've now seen, remember in the corn contract, it continued to go up with no sidewards movement. Well, we've seen some sidewards movement in the soybean market. That might ask the question here, the soybeans, has it gone high enough to bid more acreage? Remember, that ratio is 2.5. So right now it's sending a signal, but is that signal strong enough to keep the soybean acres where they need to be, or do they need to go higher? But we've had soybeans gain an amazing $4.50 basically since September, November. That's a magnificent run up. And we've had the new crop, the November 2021, go up about $5.25, even more. So actually it should be $4. I've made a calculation error there. But the thing I wanted to point out, like I did in the corn market, We've got sideways here with resistance at the $12 level. So the question is going to be, will soybeans be able to rally more and get more soybean acres planted, which the demand and supply is dictating, or will corn continue to rally and get that ratio back around the 2.4 or even lower? So the probabilistic statements for corn are the new crop soybeans contract. I calculate that there's about a 50% chance that soybeans will come in around $11.50 come December. The chances that they'll go to $14.75 or higher is about 8%. The chances they'll go to $9 or less is about 9%. Again, a huge $5 difference there between probabilities. Again, that's the uncertainty we have with the 2021 acreage and the yield we might get. Let's turn to the balance sheet for wheat. Wheat's not as positive, but it's still positive, and you'll see here it's a profitable scenario for North Carolina. With wheat, we've had a decline in planted acres, and this has been going on for a long time now, with even a reduction in yield, which wasn't helpful in terms of total supply, with total supply down about 4%. Total use was up 2.3%, and the thing that was driving that was domestic use, and with a big increase in the feed. And that feed demand for wheat has increased because corn has become more expensive, and we see some substitution there between corn and wheat. And North Carolina wheat growers rely on that, especially with the hog rations. So ending stocks for wheat are down about 20%, and the US farm average on wheat prices is about $4.85, up about 6%. There's not a lot to talk about on the wheat supply and disappearance data. It's essentially moving sideways. The thing to note is ending stocks are down more than anything else, and driven by the fact that total use was up, and we already talked about that was driven by feed demand. We've already talked about wheat ending stocks. They continue to go down, but I'm not sure they're going to go down much anymore. And if they do, it probably will be because of a lack of acres. So one last thing to talk about with respect to wheat is in North Carolina, as I'm sure most of you know, we don't price wheat off the July futures contract as you would think. We price wheat off the corn contract because wheat is predominantly used as a feed in North Carolina. About 80% of wheat in North Carolina is fed. And so you can see here that the wheat July 2021 contract and the corn 21 contract don't really mirror each other that well. In particular, we've had the wheat price soften and the corn price here remains fairly strong. So in this case, in 2021, I think North Carolina wheat farmers might benefit from that. Currently, the wheat versus the corn is trading at a deficit of about 86 cents compared to the wheat price, or the wheat price is about 16% higher than the corn price. Okay. So let's turn to North Carolina and look at the prices and the outlook here for 2021. This is a budget comparison tool that I developed, and this is just a snapshot of it. I developed it with Derek Washburn. You can see the URL to it down here, and this is just a snapshot. And what it basically does is we use close to state averages for yield, and then we plug in the current futures prices and the current new crop basis to come up with expected net prices for each of the crops in 2021. So we have an expected price for corn of about $5.36, soybeans about $11, wheat $6.22, and cotton 79 cents. That allows us to get with our state level yields the gross revenues. Then Derek has budgets for each of these crops, and you can, if I open this up, you can see each cost, and you can go out to his website and get those. In fact, you can get the whole spreadsheet. I just couldn't fit it on this slide. What we really care about is what are the net returns to farmers' risk. And it's been about 5 years since I've been able to say this, but for the first time in about 5 or 6 years, we now have corn, soybeans, wheat, and cotton based on average yields showing profits. Okay, so you can pencil in a profit here with a return to acres of $190 for corn, $280 for soybeans, $73 for wheat, and $282 for cotton. I haven't been able to say that for a long time. And here you can see the break-even yields and the break-even prices. So we're well within all of those. That means going into planting right now, current market conditions are doing exactly what we need them to do. We're able to produce a profit. So that means it's time to think about potentially locking in some prices with forward prices and potentially buying crop insurance to lock in some of these potential profits. Previous years, there was mostly at least 2 or 3 of these columns were red. So things are looking up, and this is exactly what we needed to make up for those government ad hoc and supplemental payments, which aren't going to be there in 2021. So this is exactly what we needed. This, and all the momentum right now is that prices will probably go higher. So this is a really good year for North Carolina to have a banner year with even higher prices in the Midwest, so we can get these price revenues or net returns up even higher. Let's take a snapshot at some of the prices we can get by location. I want to give a shout out to a new basis tool and price tool that I developed with Heidi Schweitzer and Robert Thompson, who's a graduate student in our department. This was funded by the North Carolina corn growers. And what you can do is go out to this website and you can access all the corn, soybean, and wheat markets. And you can get essentially 20 years worth of data. You get to choose between the commodity corn, soybeans, and wheat. You can choose price or basis. You can get all the locations. You can choose between mills and processors and elevators, and then you can choose between immediate delivery and harvest delivery. What I've pulled up here is immediately delivery for corn prices. I pulled this up in case anyone's sitting on some old crop corn. As you can see across the board here, average corn prices for immediate delivery are about $5.76 right now, with a minimum price of about $5.45, a maximum of $5.96, so a range of about 50 cents. Now, I should tell you with a caveat, these are just bids. We get these from the USDA reports. If you call, you're likely to get a higher price than this because they usually will give you a nudge in basis. But it's really good to see immediate prices all in the high $5 ranges, $5.50 plus. That's welcoming news for North Carolina corn farmers. Another feature of this basis tool is we now provide prices by destination on a map. For example, for the folks there in Duplin County, I pulled up Rose Hill, and you can see right now, as of February 3rd, with the corn futures at 552 and Rose Hill offering a 90 cents over basis, you can get $6.42 for your corn. You can see 90 cents in around here, as high as 85 cents in the southeast. Basis is nowhere near as favorable in the northeast, 50 cents, 20 cents, 50 cents. It's as much as $1 in the west, but it's around 90 cents. Again, here's the Robert's website that makes this available. This is updated daily. This is a very useful tool, especially if you're trying to shop for buyers around here. You can get to see all the different bases on offer. Here's the harvest corn bids. So let me distinguish again between this is for immediate delivery, and then the harvest corn bids are based on new crop prices, where we see the futures are 451, and basis is still really strong. it's 85 cents over for new crop prices. So right now you can lock in a price of almost, or at least 5.36. You might get a higher basis, maybe 90, 95 cents. If you're willing to do that, that'll push you up to 5.50. To put that into context, the other thing the tool will allow you to do, and I've pulled up Rose Hill here, and this is the current offer on basis for new crop is 85 cents. Here's the dot here for 85 cents. But what's important about this is it allows you to compare what it was in 2020, 2019, 2018, 2017. And you can see right now that the current basis for new crop is 20 cents higher than what it was last year. And it's tending to be 30 to 40 cents higher than what it is typically in the last 5 years. So this is a really strong signal that prices are strong right now in Rose Hill, and that you might want to think about booking some new crop corn because the basis is really strong. We've already seen the futures is good too. But I wouldn't book it all because futures have the possibility of going even higher. I don't know how much higher the basis could go, but at least if you market some now, 10, 20% of your crop, you're locking in a profit. Okay. This tool is helpful to make you those decisions. Again, this is the tool this is part of the basis tool and price tool that we developed on behalf of the corn growers. Let's turn to soybean prices, same tool, and I've broken it out again now between elevators and mills and processors. Why do I do that? Because currently there's about a 50-cent premium being offered for immediate delivery at the mills and processors, okay? Ranging from $13.87. The average is $13.87, but the range is about 50 cents again, with the low being at Whiteville and the high being at Fayetteville. Fayetteville has typically been trading at a premium over all locations because that's the biggest crusher in North Carolina. But averages of 13.41 in elevators and 13.87 is good, again, profitable for our soybean growers. Here's the map of immediate soybean bids. We can see in Fayetteville, current price is $14 with a positive basis of 35 cents. This is a very strong basis. We often see the basis at Fayetteville has been negative, or it's basically zero. You can see out here in the Northeast, we've got some basis that's negative, and we've got some basis down here in the Southeast as well. So currently, immediate delivery soybeans, the market wants soybeans like I talked about earlier. Putting it into context, again, and I've picked Fayetteville here, we can see the 43 cents historically is really strong compared to 34 cents in 2020. And like I said, it's usually zero or around minus 10 cents. So if you're sitting on soybeans right now, you're being offered a really good basis and also strong futures. So it's a good time, and the cost of carry is negative, as I explained earlier. So it might be a good time to empty those bins if you've got some soybeans. Finally, the wheat harvest prices. Again, I broke it out between elevators and mills and processors. The processors are offering about a 27 cents premium. On average, the elevators are at 5.53 and the mills and processors are at 5.80. Still really good prices. I think most of these mills and processors, I'm sure these are all Smithfield at $5.80. And there's some variation here depending on location between $5.45 and $6. When you look at the basis, and I picked Rose Hill here again, it's not like what's happening with corn and soybeans. Right now, I would call this basis average. That I've only got 1 month of data so far for 2021, but it's coming in less than what it was in 2018 and less than what it was in 2020. So this is a signal to me, if you're thinking about, and this is for harvest, it might be a good time to wait and see if that basis will strengthen. It will certainly strengthen if corn prices strengthen some more and we see some substitution between corn and wheat. But right now, historically, this offer of 85 cents is not screaming out that you really want to lock it in. It was higher uh, in 2 other years in the last five. Um, Again, here's the map of the wheat bids. You can see Rose Hill 622, 85 cents over basis. You can get that in most locations, 85 to 50 cents. Again, I think this could get stronger, especially if we see the corn market rally more and corn becomes more expensive. The integrators will want to substitute corn for wheat. So, a few final thoughts. Uh, as I mentioned, we're at 5 and 7 year price highs and they're ongoing. That is, we really haven't seen a floor yet, but we did see some signs in the soybean market that that might be happening. And these futures markets reflect that the markets are supplies are tight and there's a scarcity of stocks. The markets want sellers to price and to deliver now with a cost to carry. Again, if you're sitting on some old stock, now's a good time to probably price it and empty the bins. 2020 net income was bolstered significantly by government payments, 36% in fact, mostly by the 32 billion one-time supplemental and ad hoc disaster payments. That's going to go away in 2021, I expect. And so we need these prices to continue to get stronger and have really good yields to make up for this difference of the government payments to keep net farm income close to where it was. The big drivers have been reductions in the ending stocks due to large exports and also significant revisions by the USDA on how much we actually produced in 2019 because of the significant floods and the preventive planning we had. And then 2020 with the derecho we had in the Midwest caused more damage than we thought. So the USDA reports have played a significant role here too. I showed you some favorable budget comparisons where we had all of the row crops in the positive, which has been something we haven't seen for quite some time. I think it's about 5 years. And I've shown you that the corn and soybean markets are exhibiting strong basis, providing old and new crop marketing opportunities. And also the wheat harvest basis is right now about average. And so look for some strengthening there before you try to price any wheat that you might want to sell in July for 2020. Uh, Let me just give a shout out to the website we developed with the corn growers funding. It's got a significant amount of data. I think it can be really helpful to make informed marketing decisions. It's been up and running now for about a year, and we've already made a significant revision of it based on farmer feedback. So let me quit there and take some questions.
Thank you, Dr. Piggott. Does anybody have any questions they would like to ask at this time? All you have to do is just unmute yourself and ask, or either put it in the chat box and I'll ask it for you.
Dr. Piggott, I did have a question, and I believe you talked about it, but just in case, a lot of times I'll have guys that I'll say, I'll recommend going ahead and booking a certain price, and it'll be about February, March timeframe, and they want to wait and hold off. Is there a certain time frame when they should stop doing that?
Yes.
Certain month, I guess, that you would recommend? And you mentioned, is there a certain percentage that you would traditionally suggest?
Yeah. So typically, first and foremost, one thing that can really help if you're going to start to market aggressively around February and March, and let me tell you, historically, that's when some of the best opportunities have been. A good first thing to do is to buy revenue crop insurance because that will guarantee you some revenue if you should fall short on your production contract. Then you want to look at potentially marketing, you know, bundles of 15 to 20% of your grain, and you want to make marketing decisions based on two things. If the futures markets are really strong and will tend, like I said, to have a rally here to the side planting, then that's a signal to potentially hedge. If the basis is also strong, you've got to think about the local prices made up of futures and basis. The sum of those two determine the local price. If the basis is also strong, then that's a signal to go ahead and book it, like you said. If the basis is strong and the futures isn't as high as you'd like, then you can go ahead and do a basis contract. So the answer, of course, is it depends. But right now, between now and March is when you're going to see most of the futures action. And you tend to see basis strengthen as we get closer and closer to harvest and we know more about the crop. And in particular, it's important to understand that the basis in North Carolina, especially for corn, is driven by production that's happening in the Midwest, but in Minnesota, the key places are Indiana, Michigan, and I'll think of the other state in a minute. But we've looked at that's because that's
Ohio.
Ohio. That's where we rail it in from. Yeah. So those three states, if they have production shortfalls, that has some really positive ramifications for basis here. I hope that answers your question.
It does.
Dr.
Thank you.
I'm sorry. Dr. Piggott, what do you think, what effect is South American weather going to have on this market?
Yeah, potentially a lot because we know that the Chinese in particular are hungry for grain. And if we have big production in South America and they are hungry to export it, which they always are, they can substitute some of those exports that the US has benefited from for South American. So if we have a shorter production season in South America, the expectation will be that China will continue to rely on US exports, and that will drive our futures markets higher. This is especially true in soybeans, because as you know, the soybean market is essentially got a two-pronged approach to the world supply. The US and actually South America is actually a bigger producer, I think, than the US. And how that soybean crop does in South America is really important for what our soybean prices will be, and that also ties into corn because of they compete for acreage. So it's very important.
Does anybody else have any questions?
I encourage everyone to go out and look at that. The basis and price tool. There's a lot of really good information there, and also the budget tool that I developed with Derek Washburn. It can really help you make more informed marketing decisions as well. And if you don't like the state average costs, you can quickly change them to something else that you like that suits your operation. It'll give you a very good side-by-side comparison to make an informed decision about how you should allocate your acreage.
And speaking of Derek Washburn, we will actually be having him next week in this series on February the 11th. And he's going to discuss the ag budgets and strategic management of a farm operation. So we'll have him next week in this series. So any of you that are participating tonight, if you have not, you can use the same registration link to sign up for this next upcoming two series. That's this coming Thursday and the following Thursday. The last series that we will have, which will be the 18th, that's going to be on environmental and land use laws for farmers.
Derek will almost certainly talk about the individual budgets, but he'll probably also cover the tool, I think.
All right. Does anybody else have any questions? This is the last call. Or is everybody already going to sleep? All right, I guess hearing none. Thank you so much, Dr. Piggott, for taking time out with us tonight to discuss the markets and futures and kind of what the future is going to hold, what it's going to potentially look like. Give something for the growers to look forward to for this coming growing season.
Yeah, it's much more favourable than other years that we're going into. Not maybe for good reasons, but the prices are looking favourable.
All right, so we're done with the meeting, and in order to leave, in the bottom right-hand corner is just a red end button. Click that, and hopefully we'll see y'all next Thursday, same time, same place.